All right, welcome back to the channel. So today we're going to talk about SPY, SPY, the Spider S&P 500 ETF Trust. This is the most well-known and widely traded exchange-traded fund. It tracks the S&P 500. Ticker symbol is SPY, and this is a fund that most people have as the cornerstone of their portfolio, 50 to 60% allocation, and they hold long-term. So as you can see here, index tracked S&P 500 composed of 500 of the largest publicly traded companies in the US, representing 80% of the US equity market by market capitalization. Now let's go on Fidelity and let's take a quick look at SPY. Let's break this down slowly. The S&P 500 is a fund that most investors have in their portfolio. Normally adds up to about 50 to 60% allocation over the long term, 20 to 30 year investment period. We're going to break down the S&P 500 SPY in detail and go over its comparisons because there are better options in terms of expense ratio, which you can see right here. Gross expense ratio, net expense ratio, that is what they charge you each year to hold on to this fund. Now, the S&P 500 has 500 companies. That's what makes it so diverse. 36% of the S&P 500 is invested in these companies right here. Apple, Microsoft, Nvidia, Amazon, Meta, Google, Tesla, Broadcom, more Google, and Berkshire Hathaway. Just to give you a good idea of this, this has been around since 1993. And when you look at the overall chart of this fund, just look at the max on it. This is what it has done over the long term. So just from 1993, trading at $45 a share, all the way up to 600. So excellent returns on this and a very simple way to grow wealth. This is why I introduced this right in the beginning of the course for beginners, because this is what your long-term portfolio should look like. It is a U.S. equity ETF passively managed large blend. So what does that really mean? That means that all of the equity is in North America at 99%. It's in giant and large cap stocks. And here is another illustration of your 500 companies within this ETF, where Apple, Microsoft, Nvidia, etc., what we review, the top 10 make up 36%, and then the other 495 companies make up 63.82%. This is large blend, so it's a blend of value and growth stocks. The sector exposure of the S&P 500, 30% in technology, 14% in finance, consumer discretionary is 11%, healthcare 10%, communication services 9%, industrials 8%. Also, when you look at the industrial exposure, you do have that exposure to semiconductors at 10.49%, software 10%, technology, hardware 7%, etc. Now, what I want to show you what's really important, when you own this fund, you receive a dividend. So just for owning shares, you will get 1.17% dividend each year, which means they pay you that percentage of whatever you own. The expense ratio, which is important, is you're paying 0.09%, and there are other competitive S&P 500 funds, which we will go over at the end of this video. So you don't have to choose SPY as your S&P 500. But there are better options that invest exactly the same as this one, just for a lower fee. Now looking at the Morningstar rating, 5 stars out of the 10-year period right here, which is nice to see. And the performance per risk, you can see here, a $10,000 investment in 2024 would have netted you about $35,000 just following this bar graph right here. I like to use this because this shows you the life of the fund. It earns about 10% a year, which is excellent. So if you had $100,000 invested, you would have earned $10,000 over that period of year. Now we'll look at the comparisons just to show you there are competitive ETFs and index funds that have lower expense ratios. I want you to focus on two things: the SPY, SPLG, VOO, and then look at the expense ratio. SPY is 0.09%, SPLG is only 0.02%, which is the lowest, and all it does is do the same thing, tracks the S&P 500. Then you have VOO at 0.03%, and then IVV at 0.03%. And that just shows you that you can get the same exact ETF for a better price. Now I just want to take a minute just to show you the basket holdings of the S&P 500. I'll scroll through, but definitely feel free to take a screenshot. These are all of the companies and their weighted allocation to the fund. So Apple makes up almost 7% of this fund. But as you keep going down, you can see you have ExxonMobil, you have Costco, MasterCard, Walmart, Netflix, Home Depot. These are all companies I'm sure you've heard of before. Merck, Coca-Cola, Cisco, and the list goes on and on. I just want to scroll through so you can take a snapshot and just know which companies you are investing in. So even like Starbucks, that most people drink every single day, makes up 0.24% of the S&P 500. For a stock to get into the S&P 500 is excellent. That proves that it is a large cap company that is performing well. Now, if one of these companies does not perform well, they will remove it and put the next stock in there that is deserving. I want to show you there are other types of Fidelity S&P 500 funds that you can invest in that will allow you to get S&P exposure. In Fidelity, the top one is FXAIX. It's the same exact composition, but your expense ratio is much less, 0.015%. And I just wanted to show you this so you can see. Instead of paying 0.09 for SPY, you can see for FXAIX, you are paying 15 cents for every $1,000 you have invested. That will save you money over the long term if you are investing. There's also another option you can do where you invest in the Fidelity Zero Large Cap Index funds, and I'll post that video at the end of this, but this will allow you to pay no expense ratio, and I'll break down the differences of that in the next video for you. If you're interested in other content that is related to the S&P 500, I have the playlist on YouTube, the Mastering Fidelity Index Funds, ETFs, and Investment Strategies, where you click on this playlist and you will get a myriad of videos based on this. So definitely be sure to check that out. All free content just for you.